President Trump has just made what might be the biggest economic decision of his entire presidency. After months of criticism, the Federal Reserve, after months of attacking its chairman Jerome Powell, and after repeatedly demanding lower interest rates, he has finally taken concrete action. On January 13, 2026, President Trump officially announced who his nomination as the next chairman of the Federal Reserve Bank, set to take office in May 2026. And this decision is going to impact US dollar, the stock market, and the entire global economy. So let's break this all down. And if you want to better understand what's really happening with the economic and the markets, make sure to subscribe to the channel. Here we explain money and finance in simple, clear language. President Trump has announced that he is nominating Calvin Walsh to be the new chairman of the Federal Reserve Bank. Kevin Walsh has very different views on the economy compared to Jerome Powell, the current chairman of the Fed. But there is something important to understand. The Federal Reserve Bank is not actually a federal government agency. Even though it has the word federal in its name. Because of that, President Trump cannot fire off the chairman of the Federal Reserve and he cannot directly tell the Fed what to do. However, Jerome Powell's current term expires in May 2026, and that gave President Trump the opportunity to appoint a new chairman, which he has now done by nominating Kevin Walsh. So, who is Kevin Walsh and what does he want to do differently? That's the key question because the answers to what will shape economics policy in 2026 and beyond. Kevin Walsh is not new to the Federal Reserve. He was part of the Fed leadership during 2008 financial crisis back then when Bernanke was chairman. And that time Walsh was known as a hawk. In economic terms, hawks are people who favor higher interest rates. He was a strong critic of money printing and was openly against cutting interest rates during the 2018 crash. But over the years, his views has changed. Today, Walsh says that the Federal Reserve has kept interest rates too high for too long, or that they now need to be cut aggressively. And this is not a coincidence. President Trump has been very clear that he wants someone at the Fed who will do exactly that, aggressively lower interest rates. Trump has also said that he wants a Fed chairman who is willing to work more closely with the White House when it comes to interest rate decisions. Why does that matter? Because historically the Federal Reserve has always been an independent institution. It makes decisions separately from the government and the president. But Trump is essentially trying to change that dynamic, pushing for a Fed that listens more directly to the White House. That will be a major shift from how the Federal Reserve has operated from decades. But there is more. Kevin Walsh argues that cutting interest rates does not necessarily have to make inflation worse. He believes there is a way to lower rates without triggering higher inflation, and that way is by shrinking the Federal Reserve balance sheet at the same time. And this is the key difference in his approach. Between 2020 and 2022, the Federal Reserve turned on that is called quantitative easing, in simple terms money printing. Here's how what worked. The Federal Reserve literally created new money out of thin air and lent it to the USA government. The government wanted to spend more on stimulus checks, infrastructure projects, military programs, technology initiatives, and more. To pay for all of that, the government could borrow money from regular investors from foreign countries or from the Federal Reserve itself. And the Fed simply printed the money and loaned it to the government. The result? There is suddenly a lot more dollars in the system, but no additional real wealth. and the consequence of that was inflation. Now Walsh says the following. Yes, cutting interest rates can be inflationary because when rates are lower, people borrow more and spend more. But if you cut interest rates while also pulling excess money out of the system, in other words, shrinking the Fed's balance sheet, you can avoid further inflation. That progress is calling quantitative tightening. In 2022, when inflation exploded in the United States, the Federal Reserve started doing exactly that. They raised interest rates and at the same time began reducing their balance sheet to pull money out of the economy. That policy continued through 2022, 2023, 2024, and 2025. But on December 1st, 2025, the Federal Reserve announced that it was ending quantitative tightening. In practical terms, that means the money printer was being turned back on. And now, in 2026, the Federal Reserve is once again expanding its balance sheet, meaning more money is being created. Meanwhile, President Trump is saying, let's lower interest rates, let's make mortgages cheaper, let's make car loans more affordable. But there is an even bigger reason behind this push. The United States government is currently sitting on more than $38 trillion in national debt, and that debit comes with interest payments. When interest rates are high, their government has to spend massive amounts of money just to service that debt. That means less money for infrastructure, healthcare, education, the military, and social programs. Right now, interest payments on the national debt are fastest growing expense. Right now, interest payments on the national debt are fastest growing expense in the entire federal budget. This is one of the main reasons Trump wants lower interest rates, because lower rates mean cheaper debt for the USA government. But the obvious risk here is inflation. If rates go down, the government might simply borrow and spend ever more, which could push prices higher again. So Walsh is proposing a middle ground. Cut interest rates aggressively, but at the same time shrink the Fed's balance sheet to offset the inflationary pressure. However, there is an important reality check. The Federal Reserve does not make decisions based on what one person wants. There are 12 voting members on the Federal Reserve Board, and it takes at least 7 votes to change interest rate policy. 4 of those members were appointed by President Trump during his first term, but one of them, Jerome Powell, has clearly not gone what Trump wanted. Now Powell is being replaced with Kevin Walsh, who is much more aligned with Trump's vision. That means in theory there will be more voices inside the Fed pushing for aggressive rate cuts. And that is exactly why the markets reacted so strongly to this announcement. Right after Trump made this nomination, we saw major volatility in the stock market, because markets hate uncertainty. Lower interest rates generally make it cheaper for investors and institutions to borrow money. Borrowing is cheaper, more money tends to flow into the stock market. That is what Trump is hoping for, a policy shift that boosts stock, makes housing more affordable, and reduces the cost of running the USA government. But the big questions remain. Will the policy end up shrinking the balance sheet is usually anti-inflationary. If you found this breakdown helpful, share this video with a friend, family member or colleague. The more people understand how the economy really works, the better financial decisions we can all make. Thank you for watching.